What is going on, everybody? This is Andrew from DeFiancy. All right, guys, we're just going to jump straight into this. So we're looking at Bitcoin here. We are currently, I guess we're at the yearly highs here, or we just broke above the yearly highs. And price action is looking really great. We talked about how the Binance situation was massively bullish for crypto, massively bullish for altcoins, BTC, ETH, everything crypto related. And right now, I think it's best for us to kind of move at least this video into maybe the direction of the fundamentals. We've been talking a lot about the technicals, but you may be asking, like, why do we hold this, this bullish view going into the next few years with crypto and risk assets in general? And that's really what I want to cover today. But one of the things I want to talk about before we get into some of the fundamentals is a psychological phenomenon called recency bias. So recency bias is when, and we're going to talk about this in respect to financial markets, is when people, they see events that happen in the markets, this pattern that happens over and over and over again. For example, prices going down, bearish sentiment, and things not looking good. And their brains basically create that as what is most likely to happen in the future. Kind of like, I'm not a psychologist, so maybe I'm not explaining this as well as I should, but people get this kind of this recency bias. They have a bias towards the same thing that they're experiencing now for the future. If that makes any sense. And this is really important for markets because I think this explains the situation we're in with risk assets right now. People are assuming that conditions for risk assets are not going to be favorable going forward, and that is usually what happens when you're coming out of a bear market. Okay. And I think we can come to conclusions that this is definitely not good for investors to have a bearish mindset going forward. At least that's our opinion. I'm going to go into a few reasons why. Let's see if I can find some of my charts here. So this is a chart of global liquidity that you're looking at here. Okay. And most people, including myself to a certain extent, did not really understand global liquidity in its real form, and like how it actually is in reality, as opposed to what I was seeing and what other people are seeing now on CNBC and Twitter, and all these different media sources have this like bearish view, or have had a bearish view of liquidity in general over the last year and going forward. And they were, this was basically the fundamental denominator behind a lot of smart people, like their investment thesis, right? Like, and they got it wrong. And we can go over reasons why they got it wrong, but I think the main thing that I want to get across in this video is you do not have to be an expert in macroeconomics to understand, or just macro in general. You don't have to be an expert to make basic rational decisions on the data that we're seeing. And I'm an engineer, and that's just really what you do as an engineer. You don't have to be an expert at every part of a system to make educated guesses about how the different components of a system may interact with each other. And that's kind of how I see this situation with risk assets and global liquidity, is that it really is the common denominator, and you don't have to be an expert to know that if it goes up, risk assets are going to do well. And there's a lot of other things in the background. There's a lot of noise that I think really distracts people from that. That ultimately it is an appetite for risk and the availability of liquidity to move into assets that ultimately are going to move the price, and vice versa, right? People risk de-risking and liquidity being sucked out, right? That's really what moves markets. And as you can see, we have been trending up over the recent few months, and I might need to move me over a little bit here. I apologize. This is a map of global liquidity. And actually, you might not be able to see it that well here. Hold on. Okay. So we've been trending up over the last few months. I wish this was I wish the resolution was a little bit closer, but I want people to look at this section here. This was last year. So this was like the heat of the bear market, as stocks were seemingly going down like, every other day. They were like, it felt like they were crashing, right? In 2022, it was not a good year for stocks or bonds. And we bottomed in global liquidity actually in October of 2022, and that was also the bottom of the stock market. This was towards the end of October. And then we had this big, move up in global liquidity, and that was the rally that we had early last year. or I'm sorry, the end of last year and into this year up until about, I think it was really July was when it really slowed down. You did have that hiccup in March with the banking crisis, but that was really the peak in like July of this year. That's when stocks topped out, right? And then we had this downtrend in global liquidity, if you see right here. And that was because of collateral. So as we had these bond auctions going off, people didn't want to buy bonds while the government was actually issuing bonds, and it was creating a lot of volatility. So as that happened, people's credit, or people were having credit issues that are that typically invest into assets as their collateral was going down in value, but more importantly, the volatility of that collateral was causing the amount that they could borrow versus that collateral to go down. And this really freaked people out. A lot of people thought this could cause a contagion and that we could have a market crash. There was a lot of people, calling for a credit crisis. And that caused the markets to go down, as we saw over the last few months. But now we're back into this uptrending phase. And again, I wish this resolution was a little bit closer or zoomed in, but we're starting to go back up in global liquidity. And this is super important to understand, because if you have the appetite for risk and global liquidity isn't going down, in fact, it's going up, assets are going to go up, most likely. It's very difficult to have a bearish point of view with that, with those two things being true. Now, one of the other issues that people had and still have about investing in risk assets right now is they're worried about a recession that may come in 2024. And I'm going to contradict myself. Our point of view that we gave out in just a few videos ago about how we might be going into a recession, because I think I've come to conclusion now, and maybe I'll change my mind a few times on this, but as of right now, I actually think I was incorrect on that. And I'm going to show you a chart here. Bear with me, guys. So this is a chart, move me over here, of iron ore. And you may be saying, Andrew, why are you showing me a chart of iron ore? And the reason why I want to show you this chart is because I think it may be the best, or one of the best, leading indicators for gauging whether you're in a recession or not. The reason for that is when the global economy is scaling, when it's expanding, iron ore is going to go up in value, because that is used for so many different things to build things, right? I mean, it really is like one of your industrial bases. You need iron to make steel, okay? And it's really important to understand that, because anytime you have a recession, I can almost guarantee you that iron ore is going to go down in value, because you don't have the demand for it. It's just supply and demand. And as you can see, when we had COVID, and I'm going to move me back over here. Sorry, guys. When we had some second order effects from COVID, meaning you had the slowdown in China and really the world, iron ore demand fell dramatically, right? And that was a really good indicator of a recession, and a lot of economies were going into a recession. In fact, the United States was actually in a recession, just no one called it that. We had consecutive quarters of negative GDP. The market people really didn't talk about it because I'm not even going to go into that, but the administration basically acted like the rules for a recession had changed, but we were kind of already in a recession, But as you can see, it ranged after that for quite some time. And it's funny how that's kind of like also what the markets have been doing in general. Risk assets, some of them have been going down, but the stock market has been really in a range, right? And now you're starting to see this really look like it's definitively headed in the up direction. I think that's important to understand, because that indicates that you're most likely not going into a recession. How would the price of iron ore be going up if you were in a deflationary, recessionary, or going into that, that type of environment? It just doesn't add up. It wouldn't make sense for that to occur. And again, it's just one data point, but I think, again, it might be one of the most accurate. So I think we are in a very interesting situation where a lot of people have hedged and expected really poor outcomes with the economies going forward into 2024, and they were scared to buy risk assets because of that. And that seems to not be the case. And you couple that with positive earnings, so good earnings over the last quarter. So we were actually going down in the stock market and also in crypto, while earnings were actually doing quite well. And it was because of that the bond collateral situation we were talking about for the most part, in my opinion. But had that situation with the bond market not taken place, you probably would have gone up in the stock market, because really the stock market wants to see lower interest rates and wants to see good earnings. right? Well, it looks like the Fed is done hiking rates. It looks like we're not going into recession right now in the short term, and earnings are good. So this is kind of a perfect situation for stocks and crypto and risk assets. And I know a lot of people will disagree with me, but until I can see some of the those three variables change, I keep it simple, stupid, right? Just look, this is this is the reality, right? And a lot of people will say the market is wrong, but really, how is the market wrong? I mean, there's a lot of really smart people that are actually participating in the market, and I don't think that the people, a lot of the guys saying the market is wrong, they think they're smarter than the market. Well, I actually think the market is smarter than they are. That's just my personal opinion. And I guess what I'm trying to get, the reason why I'm showing you this, okay, I know we're kind of going around different places here, is that if this is the case, we're not likely going into some impending, doomish recession, and global liquidity looks good. This is again perfect. This is a perfect recipe for risk assets, and that is crypto, and that is something I think that is going to benefit disproportionately from this environment that we're in. And if we look across the board here for crypto, it's been doing quite well today. You have tokens like DYDX. We talked about that. It's up about 10%. Synthetics protocol, we're going to talk a little bit about that later. That's up about 8%. Avalanche up 3.5%. The altcoin market is looking good, right? Because the appetite for risk and those variables that we just talked about are there. So this is a very bullish situation going forward into next year, I think. Doesn't mean that it's going to be up only and there won't be hiccups along the way, but I think the wind is now at the bull's back. And this is really great news. I want to talk a little bit about some of these altcoins, okay? Because I think, again, if we're going to go into a risk asset, a risk-on situation, altcoins and crypto in general, they are going to disproportionately benefit, from this environment that we're in. So let's look at what's been performing well over the last 7 days, and I'm just going to cover a few of these. I want to cover like a few altcoins every daily update from now on to get people familiar with these things, so that they understand, what is trash, what could be valuable. There's so much scams and crappy stuff in this space, but there's some real value if you look closely and carefully, in my opinion. And I'm not saying that I'm a fan of Blur, but we'll just cover that here. Blur is an NFT platform, and it's one of the dominant NFT platforms right now. I think it has attracted a lot of liquidity into its protocol because of some incentives that it might be providing to its users, meaning it's probably inflating its token supply to accomplish that, but it's definitely hot. People are using it. A lot of people want to invest in different sectors within crypto, whether it's gaming, NFTs, DeFi, whatever. And if you wanted to have an allocation within the NFT space, Blur is probably one that you would want to look at. Doesn't mean that it's safe or it's going to be successful, but it is one of the tokens within the NFT space I recommend people keep on the radar. But I'm not really sure exactly if their revenue is great, profit models, is it sustainable? That's something I'd have to look further into. But we're just going to kind of start to look at this, right? Keep it on our radar, right? Now, synthetics, I have a lot more to talk about with that one. This is what I would call a DeFi primitive. Synthetics protocol is effectively a liquidity protocol for synthetic assets, and that might not mean a lot to like the average investor, but someone in the traditional finance, TradeFi and traditional finance, they would see that as, wow, that's pretty cool. So basically, you're taking existing systems within the financial system and you're decentralizing it. Basically, projects, applications can build on top of synthetics and create like trading platforms that trade synthetic assets. And one of those trading platforms that has actually built a product on top of synthetics is Quinta. And we're going to pull that up here. Okay, and the reason why I like synthetics is, again, it's a building block. It is like a layer for applications to build on top of, so that you could have Quinta, which is, again, it's a trading platform. It's really like a front interface, and then synthetics is like the engine of it. You could have a bunch of different people building products on top of synthetics, and synthetics gets to benefit from all of the products built on top of it, right? And as we can see, synthetics is actually earning money. They are generating revenue. So this is a website called Crypto Fees. It's cryptofees.info. And we can see that synthetics is earning roughly about $150K a day in fees. That's pretty good, Okay, I really like to when I'm looking at when I'm looking at projects, but especially applications, I want to see like, are they making money? You know, are these decentralized companies is really what they are? Are they actually making money? Right? Because if they're not making money, I'm not really interested in it because that means no one's using it. And um, yeah, I like to keep things simple. I think when investors do come into this space, they're going to say, okay, what are the applications that people are using? And synthetics is one of them. And we can see that DeFi in general is doing pretty well right now. So it's MakerDAO average about 200K per day in fees over the last 7 days. You have Uniswap earning quite a bit more, about 1.5 million per day in fees. And these fees are not necessarily distributed directly back to the protocol. It's or like what I should say is like the actual DAO itself, or the like the team. A lot of this revenue for in the case of Uniswap is actually coming back to the liquidity providers, which are the people actually providing liquidity that allows Uniswap to actually function. But again, I'm rambling, I'm going all over the place. I think people need to understand that it's really important when you look at the value of these protocols, how much money is coming through them. Is there a revenue model? Is there somewhere where these protocols are actually being able to extract money out so that they can grow, so that they can grow, that's important, right? If the protocol is not making any money, how is it sustainable, right? They need to pay developers, yada, 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 right? And this is probably going to be, again, where the institutions or just large hedge funds, people in general with real capital that are smart, in my opinion, this is where they're going to come look. They're going to say, which protocols are actually being used, and are people paying money to use them? Because if someone's paying for the service, that means that service, or if a lot of people are paying for a service, that means that service is useful. So these are the useful things right here. Doesn't mean that if it's that if it's not on this list, that it's not useful, but this is the best source of information I have seen for applications so far within the crypto space. Okay, so I think that's all I want to cover today, guys. We're going to cover, again, more altcoins. I want to go more into altcoins here. We're just covering a few today. Every day we want to cover more, just to get people familiar with them, and maybe go into a little bit more about like how these things work, and eventually we'll probably put out some videos on how you can actually use them, like in the case of something like Aave or Uniswap, to actually enhance your own experience within DeFi. But I think, again, that's all we have for today, guys. Until next time, happy hunting, friends.